what we're going to be covering in chapter 2 is related to just business transactions. So when we're accounting for in accounting, all we're accounting for are business transactions in monetary units in dollars generally. And so what is the process for what is the steps in the process related to these roles, and what are source documents? And so the concept here is this: there's a system of accounts. And so the system of accounts make sure that what we're doing, what the point of the system accounts is. Make sure you know that it's to identify, analyze, and record relevant transaction information. This is going to sound very abstract, but I'm going to keep it simple. If I have a business and I received cash in exchange for my consulting services, that's a transaction. What happened to that transaction? I performed services and I received cash, right? There's always two sides of a transaction. I got money, someone lost money. Why did I get the money? I got it because I performed a service. In accounting, we always need a source document. What would that be? That would be a receipt or a bank statement. In my bank statement, I see that I got cash, or I have a physical receipt that why I received the cash. So we'll identify the source document. Every kind of business transaction has a source document. We analyze those documents. We'll analyze the receipt where it says, hey, I got cash in exchange for my service. And then we record it in a journal. These are called journal entries. And I have a whole series on journal entries. We'll go over them. We record those events in a journal using a journal entry. And then all of those journals entries get posted to something called the general ledger. Memorize this flow. General ledger. So the general ledger is just where all of the journal entries are posted. And then we prepare and analyze something called the trial balance and the financial statements in order based off of these source documents, based off of these journal entries. And so the whole concept is eventually to get to financial statements. That's the point of journal entries. But the journal entries are analyzing source information. That's all it is. We have source information. We're trying to figure out how to get in the financial statement. Remember the big picture here. Source information, try to get in the financial statement. How are we going to do that? We're going to input it into a system using journal entries. And so here's just some ideas of source documents. You could have employee records, you could have checks, you could have bills, purchase orders, bank statements, tickets. I think that you can read that on your own. And so describe an account and what is used, how it's used in a transaction. And so an account is just lumping a similar type of transaction into one classification. And so we might have something like a cash account under assets. Cash under assets. Why would cash be an asset? Because it's something that the business has, right? We have our assets equal liabilities plus equity. And so cash would be anything on our bank statements, right? Cash is a very clearly defined account. And so an account could be cash, it could be plant, property, and equipment, it could be accounts payable, accounts receivable, something where we can lump in some similar transactions. And they're always going to be related to asset, liability, equity, revenue, or expense. And all that's recorded within a general ledger based off of the journal entries. And so here we see this assets equal liabilities plus equity. I recommend, this pictures aren't great, but I recommend that you memorize what are asset accounts, liability accounts, and equity accounts. And that's what these next slides are. So this is something you have to memorize, but you can also understand the logic for it. It's relatively simple. So we have cash accounts receivable, notes receivable, prepaid accounts, supplies, equipment, buildings, land. What do all of these have in common? They're all assets. Why are they assets? They're something the company has. The company has a right to receive money. The company has a right to use in a prepaid situation, they have the right to use an office over a certain amount of time. The company has cash. The company might have land and equipment. This is all something the company has. How are these funded? Through liabilities or equity. Liabilities or equity. So what are example of liability accounts? Accounts payable, notes payable, unearned revenue, and accrued liabilities. Memorize these, but these make sense as liabilities. What are liabilities? Liabilities are something we owe. That's all it is. Liabilities are just something we owe outside of the organization. Accounts payable, that's something we owe in the short term to people for our businesses, generally for short-term supplies. We might have salaries payable for our employees, notes payable for long-term for the bank, accrued liabilities, and unearned revenue or deferred revenue. That's revenue that we've received cash for but haven't earned. And then equity. Remember, assets equal liabilities plus equity. Memorize that. Assets plus liabilities equal liabilities plus equity. And equity is our revenue minus our expenses, less our capital distributions, plus our capital input. So our capital input is our common stock. Our capital distributions or dividends, revenue, and expenses are all equity accounts. Just memorize these. I need you to memorize all your asset accounts, your liability accounts, and your equity accounts. And it makes sense, right? Equity is something the company has, that the company has right to, or the owners have right to. And why does do the owners have right to? Because revenues minus expenses is your net income. They earned it, or they put the money in through common stock or capital input. Okay, and then here's just revenue and common stock increase equity, expenses and dividends decrease equity. Again, if expense, that makes sense, right? If we spend money, we are going to decrease our equity if we have an expense. If we distribute money to the owners, then we're going to decrease our equity. So this goes to my other slides here, right? So we can go through a quick example of what this would look like from a journal entry. And so I'm going to go over journal entries in detail, but I want you to see how this all ties together. And so let's do this with a business. Let's say what a business, remember the business entity principle, a business is separate from its owner. So let's say I authorize the issuance of 1,000 common stock with a 1 cent par value in exchange for $10,000. We'd first say that's a transaction. There'd be some kind of source document related to this, right? There'd be an articles of incorporation. There'd be a legal document that states this. And there'd also be a bank statement that showed the transfer of cash. This here is a journal entry. This is what we talked about, right? We find the source document and then we journalize it. We analyze the transaction and make a journal entry. So here we debit cash. We'll talk about debits and credits soon, but we'd increase our cash by 10,000 and then we'd increase our equity by 10,000. And so that's what we'd see here. I'm going to talk about, we're going to talk about how the trial balance works, how it balances, and ultimately how it flows through the financial statements. But our asset, right, the asset would be cash, and it's funded through equity. We received, the business now has 10,000 cash, which they receive from the owner, and in exchange, equity increases 10,000. So it balances. That's what we're talking about here. And then equity accounts that would be decreased are expenses and dividends. So this is just showing the process of everything that that whole transaction. This is showing the process of how that all happens. And so what is a ledger and a chart of accounts? So the ledger is just in a collection of all of these accounts. So back in the day, remember accounting has been around for thousands of years. And so back in the day, you'd have books, really big books of all the different journal entries, and someone would actually be writing each journal entry down, and it would go to a full ledger. And that ledger would have a chart of accounts of, hey, what does the business actually do? What does the business have? And the numbers related to these accounts. And so a chart of accounts shows every kind of account the business has, cash, accounts receivable, et cetera. You can see it here. And they'd be classified by numbers. Normally the numbers would be 1 series, so 101, 102, 103 for assets, 2 series for liabilities, 3 series for equity, 4 for revenue, and 5 or 6 for expenses. That's all it is. It's just laying out the lay of the land. Here's all of the accounts for this business. And so what I would expect you to know for this is we need you to know what is the classification for all of the different accounts. That's your duty. That's your job for this chapter. I want you to be able, if I say, hey, what's prepaid rent? You need to be able to tell me that's an asset. What's a note receivable? That's an asset. What's an accounts payable? That's a liability, and so on and so forth. So practice this. Keywords, I like this. Keywords, if it's prepaid, it's always an asset. If it's a receivable, it's always an asset. If it's a payable or unearned, it's always a liability. Another thing to add here is deferred. If you hear the word deferred, it's a liability. I'm going through this quick, but if there's any questions, feel free to put them in the chat. Anyone have any questions so far? Is this making sense?
I just had a quick question. How is prepaid an asset? Does it just mean that they paid the whole year's rent in one go, or?
Yeah, good question. Yeah, it doesn't have to be rent. It could be anything. You could prepay for services as well.
And
So that's a right you have. That's something that the business. So let's say you prepaid me $1 million to do accounting and consulting services for your business. In theory, I would have a liability. I would have unearned revenue because I received $1 million for services I did not perform. And you would have a prepaid asset because you have the right to use my services for the next year. Same thing for rent. Does that make sense?
Yeah, thank you.
No problem. Any other questions so far?
Yeah, I have a question. So
Yep.
deferred revenue would not be a liability, right?
Deferred revenue would be a liability. It's the same as unearned. And the reason being, so that same example, someone paid me $1 million for work over a year. They paid me on retainer. Then I would owe that service. So it depends on who you're looking at the transaction, whose perspective. And you always have to ask that when you're doing accounting work. That's what makes it interesting. Are you talking about me or are you talking about the person paying me? If we're talking about me, my business, if someone paid me $1 million to perform services over a year, that's unearned revenue. That's deferred revenue for me. I haven't earned it yet. I have to work for a year. Therefore that portion that I haven't earned yet is a liability. If it's the business that's paying me, if that's the books we're assessing, that's going to be a prepaid, right? There's always two sides of it. Does that make sense?
Yep. Thank you.
No problem. So that's a key, really good point, really good question. Always ask yourself, who is the owner? Who am I assessing? Who am I helping here? Because it can get confusing if you start thinking in the other business. You have to be very careful with what business you're assessing. Any other questions? This is good. Bring them on.